So hi, this is Sherron, the Modern Savvy CPA, and the second half of us talking about credit and the importance of credit in our everyday life, whether it's involving debt or not. We're talking with Credit Christie. That is her stage name. So we're definitely wanting to have this conversation with Christie. She has loads of knowledge in this industry, and we are going to get her to share some of that knowledge with us. Hi, Christie.
Hi, thank you so much for allowing me to be here with you today.
So Christie, can you tell us a little bit about yourself to start off with, and then we'll get into our questions.
Absolutely. My name is Christie Naruzzi, also known as Credit Christie. I've been in the real estate industry in a whole lot of different angles since I was 17 years old, and more recently a mortgage loan officer of 12 years. But I also know just how powerful credit can be in one's life. It can really help propel you towards wealth and financial stability, or it can complicate things and keep you from being able to utilize credit the way that many people can and are doing to help them move forward in their life. So I've really gotten into the credit space in the last about 4 or 5 years. I'm a credit geek. I love everything credit, and I'm not a credit repair company. I am a certified credit specialist and a certified credit counselor, and I just love to be able to empower people with the right information about credit because it's a game, and when we know the rules of the game, we can win.
That's exactly what we want to teach. And the thing is, what Christie's saying is what I'm trying to bring on to our show here, our experts, is people who are passionate about the subjects that we're talking about. So when we had our real estate gal, she's really passionate about real estate, because it's one thing to be in the industry and have that job, and it's the other is to be passionate about it. So Christie is just, like she said, she's a credit geek, but she's passionate about teaching the literacy when it comes to credit. And you're also a published author, correct?
Published author. My first book was on for first-time home buyers. It's on Amazon. My next book is coming out this summer. It's about money beliefs. And I also have a podcast that's all about credit. It's called Credit Coaching by Christie.
Awesome. So we're gonna make sure you guys have all of that in our YouTube and all of our social media, so you can follow Christie and see how she can help you with your credit journey and your financial literacy journey. Because right now it's all about what you know, and if what you know can open up your avenues into building your wealth and having your financial freedom and all the things that you need to make sure that you live a content life. So so the next question I want to ask you, Christie, is we're going to talk about a few different things that you're going to help us with today, and we're going to talk about the first thing I want to talk to you about is what's the impact of increasing your minimum payment on a credit card? What does it have, on household across the country? What kind of impact?
Yeah, that's a great question. There's multiple ways to answer it, but let me just share with you that since last year, the prime index rate has gone up significantly. So last year, the average APR on credit cards was about 14%, and now it's greater than 20%. So if households just make the minimum payment on their credit card, they're going to take years and years and years and pay an additional hundreds, if not thousands, of dollars in unnecessary interest. So let me give a quick example. Let's say you have a $5,000 balance on your credit card and you're carrying it forward, say month after month. Maybe you're just nurturing that monthly payment and you're keeping that balance outstanding. If you had a 20% APR, about $84 of your $100 minimum payment would be going towards interest. So $16 is not going to tip away at that remaining balance. It would take you years and years to get rid of that balance, assuming you're not putting anything more on it. So what I'm seeing as a trend right now is a lot of households that are unfortunately carrying large balances forward every single month. They're not in a position to be able to pay that balance down. Now, the payments on credit cards, there's a couple different algorithms that the creditors use to figure out what your minimum payment is. a nice rule of thumb for most balances is about 2% of your outstanding balance. So again, back to that $5,000 balance, your minimum payment would be $100. So it's enough to cover the interest and just a little bit towards principal. Now, if your APR is 24.99, that interest payment alone is $104 and some change. So it won't, your payment is now greater than $100. So as the APRs increase, the minimum payment increases. And if you're not calculating in that growing monthly payment, then that's going to affect where you have money for other things. You're going to have to pull it from someplace else, from your grocery bill, from your fund bill, something along those kinds of, you talk about buckets, right? The money that you have. You've got to pull that money from some other place. I'm seeing a lot of people that are struggling right now because they can't get out from underneath those monthly payments with growing APRs.
So, that's one of the things we spoke about on our previous video is the cost of credit. So, the cost of something that you buy on credit is not what you put on the credit card. It is this APR that you're talking about. And can you tell us, for some of us who need to have, go back to Literacy 101, is what does APR mean, and a little bit about what that is?
APR stands for annual percentage rate. So almost all credit cards out there are what's called a variable interest rate. And it's variable because it can change over time. So it is tied to the prime index rate. And there is some credit cards will calculate it as a daily APR and some as a monthly. So it just really depends on what kind of credit card you have. But there is an algorithm on how you can figure out how to calculate your own APR. But every credit card comes with an APR. It's essentially the easiest way to explain it, the interest rate and the cost, your finance charge on what it is to borrow that money.
Your finance charge.
Your finance charge. So for every $100 you borrow and keep on that credit card, you can take your APR and know that that's the charge or the cost. So if you have a 20% APR and you keep that balance going forward every single month, you're adding 20% to what you've borrowed. So it costs you so much more, 20% in this example, to borrow that money if you don't pay it off every single month. And there is a grace period on most credit cards of 25 days. So if you pay that entire balance during that grace period, then your APR is zero.
That is true. So that's what we're trying to get everyone to do. Today, we don't use credit card as to, years ago when I guess maybe you and I was younger, it would be something that you use on large purchases and different things. Today, it is just a mean of electronic currency that we use for everything. We never have cash. So we want to make sure that we understand that when we're using this, it's not an addition to our buying power. It's a supplement. It's a complement to our buying power. So, instead of paying cash, we're paying with the credit card. So we need to pay the credit card bill with our cash.
That's exactly why it's a higher APR than, say, a loan would be. An installment loan is typically single digits in most cases, right, as far as an interest rate. The reason it's high is because it's intended for short-term use and convenience. It's not intended to be an extension of your income. It could be used for an emergency or for those things that you don't want to pay cash for. So it's really important to follow that budget that you're teaching about, to know where your money, your outflow is going, so that way you can pay that off. Otherwise, a big chunk of your take-home pay is going towards servicing debt, which is going to keep you from being able to accomplish your other goals, because you don't have anything left over to put in the savings bucket that you're talking about to accomplish your goals.
So that's the thing we've been talking about. So let's say you go out to dinner and you spent $100 today, and you before you go, one of the things that I'm trying to teach people is stop with the impulse. Understand what you're doing, and before you do something, think about it for a little while and fall in love with it, and then make that decision. So if you go out to dinner and you spend $100 on dinner and you're not able to pay that off, like I pay my credit card every week, because it's instead of paying for cash. And one of the reasons I charge everything on my credit card is because I can track it. So, and I don't have time to sit there with my receipts counting my cash, because that'll never happen. So realistic, that it's something that I have credit cards that I can track in my Quicken 20 years ago. So it's important that you are able to track this, and you're able to track it when you have time. So like I said, I pay my credit card every week because it's my cash. So if you have $200 of cash that you're going to be spending for the week, then at the end of the week, you pay that in your credit card. That's because you're using it for your household. So that's how it is in today's society. You're using your credit card to pay for your household. So the same cash you pay your credit card bill off with. Yeah. So my son, who when he turned 18, and he asked me, Mom, when he got his first credit card, when should I pay my credit card bill? I said, pay it when you get paid. So that's a rule of thumb. Pay it when you get paid. Make sure you're tracking it. Nobody has excuses these days because we have apps. Everybody's on their app. They know, when I charge something on Amex, it pops up. So there's no excuse to say, oh, I didn't know, I didn't know just is a Crimea River story. So, okay, let's go on to talking about some myths, so I know that there's a lot of people trying to teach financial literacy out there, and there's so many little tidbits that people hear there, wherever. And when it gets from one place to another, it's a total myth. So I'm going to have you tell me your most interesting myths and bust them for us today.
You got it. So a couple of top myths that I get to conquer and destroy here is, let's start off with your credit history. So your credit profile, your overall credit algorithm is created based off of what is open and active now. So let's say a few years ago when interest rates got really low, you did a refinance on your mortgage, but you had that original mortgage for 5 years. That relationship ended the moment it was paid off and a new loan gets started. So that length of history, that 5 years you may have had prior to, has ended, and it's not part of your algorithm any longer. So I've seen some people say, my gosh, I've had credit for 30 years, but do you have something open and outstanding right now for 30 years? Because installment loans paid off, they're closed. Now, revolving, which is credit cards and home equity lines, if it has a zero balance, it doesn't make it closed. But the minute you close that account, it no longer calculates as part of that overall algorithm. So that's a misconception that a lot of people have. So you want to look at your oldest length of history. Say you have a credit card from college. I would encourage you to not close that up. Sure, keep a zero balance on it or a very low balance, especially if it has a higher APR. But keep that baby open and active. And sometimes credit cards will get closed because of inactivity. So use it every once in a while. Just don't forget to make that payment. So if you go and put gas and groceries on it, maybe that same day go and pay that outstanding balance so you don't forget, because the last thing you want is a missed payment. So the biggest part of your overall algorithm of your credit scores is from your payment history. So we got to pay that on time. And that's something we can 100% control. Another myth is if you have outstanding credit card balances, it's good as long as it's being paid on time. And that's not necessarily true. There's something that's called debt utilization. And there's a really big misconception on that. It's mostly with revolving, which again is credit cards. And what you really want to have is a very, very low balance against what's available to you, which is called your limit. So if you go to a very, very high amount of what's available to you, it's referred to as an overutilization of credit. And now you actually look like a credit risk. So your credit score is going to be punished because of it. So there's two thresholds. A nice first threshold is 30% or below of your credit to carry as far as any balance at any time. And then the next better one is under 10%. For some reason, 9% is like this magic number to the three main credit reporting bureaus, which is TransUnion, Equifax, and Experian. Sometimes people think that their income, therefore their debt to income ratio, is showing up on their credit report, and it's not.
It doesn't.
So your income might be reported to, say, your bank, because they want to be able to know what kind of products to offer to you. Do you qualify for that, travel points advantage credit card, or do they want to offer you a high APY for a money market account because you might have some money out there that they could, ask you to bring in? But it's not reported on your actual credit report. So the creditors aren't able to figure out if you have a really high or low debt to income ratio. That's calculated when you apply for a loan, say like a mortgage loan.
Right.
You're going to create that based off of your income and your debt. And the last thing I want to tackle is merged or joint accounts. Sometimes people think that, oh gosh, if I get married, my spouse's lousy credit is going to affect my credit rating. And that's not true. They are two separate reports, but they must report on one merged account report rather. So they would both reflect, but it doesn't merge your accounts together or mush your credit history together. It's still two very separate things. So if one person has collections or a repossession or something like that, it won't affect your credit rating, although their credit score might keep you from being approved for a loan because they may not qualify with the minimum credit score or the kind of credit profile that lender is looking to have in order to approve that loan.
Say, for example, you're doing something jointly now, like let's say you're going to buy a house jointly. Their credit score might affect, and vice versa, the loan that you're going to get, the interest rate, because their credit worthiness is part of the equation, just like your credit worthiness.
Yes, it absolutely is. But somebody's lousy credit profile doesn't merge onto yours. So
right.
It's not, right?
Right. It's not contagious. Yes. So that's a good point. I'm even learning a few things from you here. So I'm definitely understanding. I think one of the last misconception that you talk about is the merging of the credit report. You have to understand that it's separate, but can come together at certain times. Certain things comes together.
If you're applying for, say, a mortgage jointly, if you're married, we can look at both credit histories on one report, but it doesn't put his on hers or hers on his or his on his, whatever, right?
Right. What about an additional card holder? Could you elaborate how, like, let's just say your husband has a credit card and you become an additional card holder. Many people don't understand how that works.
This is my favorite tip for increasing somebody's credit score if they have thin or poor credit history showing up. So becoming an authorized user on somebody's credit card is the number one way to quickly get your credit score up. So what you're looking to do is you're looking to be an authorized user on somebody else's credit card, say, your mom or, your grandma or somebody who's had a long-standing credit history with preferably a bank-issued credit card, Discover, Capital One, Chase, something like that, as opposed to like a store credit card. The goal is something with long-standing history, 5 years or longer, a high limit, and a low balance. Sometimes zero balance doesn't help as much. So if you're going to be on mom's card and she hasn't used it for 3 years, it may not have that positive impact that you're seeking. But I've had somebody go from the high 500s to the low 700s in literally 2 weeks, 2.5 weeks once it was reported. So as soon as you get added as an authorized user, the next bill cycle, when that creditor now reports it to the bureaus, it will show up on your credit report. And there's no negative effect to the person who's issuing, approval for this authorized user. So let's say I was going to add my husband and he has lousy credit. His lousy credit won't affect my credit with the credit card holder.
Does it affect if the person that you are becoming an authorized user on, the primary, what happens if they don't pay their bill or they default on things like that?
Yeah, that can actually hurt you. I had somebody who was an authorized user on their mom's Home Depot card. Mom and dad were renovating their home, and so that credit card was maxed. So I was able to improve their credit score by removing her as the authorized user. So in that case, that credit history completely disappears as if it didn't exist ever.
That's awesome to know.
Being an authorized user is that, let's say Grandma had 10 years with this credit card, that 10 years worth of history goes onto your credit profile. It doesn't start the day that you became an authorized user. You get it from that card started. That's where the magic is at.
Oh, I like that magic. That's a super good tip to know that. I mean, I didn't even know that. So that's very educating.
Great way to help your kids, like your, adult kids, establish a good credit, history without going into debt. And so for people who, say, for instance, follow Dave Ramsey and he says you don't have to have a credit score, which I disagree with. You will pay more if you don't have a credit score, but you can have a credit score without taking on debt. There are strategies that you can do so, such as this, being an authorized user on somebody's credit card. You never have to swipe that credit card. You don't have to have ownership of that credit card, have it mailed to the person's home that is the owner of that credit card. It just simply reports as a trade line on your credit.
So let's talk about that. Like we've heard about, my feeling on things is all these things exist in the world. And if it exists, whether you like it or not, you need to be aware of it, and you need to be educated about it. You need to educate your kids about it. It's happening. So certain things in our society and certain things in the world is happening whether we like it or not. So I like to educate my children on what the trends in societies are and what we have to keep up with and what's happening. And they in turn educate me on the same way. But, because I just believe that we need to know what's out there and how to handle it, then wait for the bridge for us to cross it. When we get there, we might not even have a bridge to cross when we get there and we're stuck on one side. So let's talk a little bit about, things we need to educate. Like I know, it's been said credit is bad for you. So in my first part of this, I said, if used properly, it's an essential part of the American economy. It's an essential part of the American society. It's an essential part of building wealth.
Yes, I'd love to address that. So just like a lot of people say money is evil, money is not evil. The love of and chasing after money could be considered evil. So credit is not evil. Being able to utilize it properly the way it was intended to, which is why there's a credit profile put out there, it's just simply a snapshot in time, your credit report of your ability to borrow money and pay it back on time. And that's it. We can keep it that simple. But what happens when people get their hands on credit, like a credit card or a loan, and they're not taught the fundamentals, they can get themselves in trouble. So when there's something that's called the broke trap that I have found a lot of people caught in. So let's say I'm new in the adulting world, right? I'm now on my own and I'm trying to figure out my housing costs, my car costs, my cost of living, all those things. And I just simply don't have any money in like an emergency savings and something goes wrong. The only thing we can count on in life is that like something's going to happen, and it doesn't, we need to just be prepared for anything, right? And be prepared with having an emergency fund. So if something happens and I get a ticket, I have to pay for that ticket. I get injured and I have a deductible on my insurance. Name it. We could come up with a lot of different things. You have an emergency fund to tap into. If you don't have that emergency fund, what are you doing? You're borrowing money, usually from another entity. You might get a short-term loan, like a buy here, pay here. I've seen people get title loans on their car title. And by the way, 89% of people who get a loan against their car title have to get a new loan at the end of that term because they're not in a position to be able to pay it off. So a lot of times people will rely on credit cards. So now you've got X dollars on your credit card, and now you're feeding that monthly payment. And there's a really good chance you have to go out and put more on that credit card. So now you've got this debt that you didn't have before that you have to pay each month. So as you're putting more on that credit card and trying to find your way, maybe your credit score is suffering because now it's a high utilization on that debt that we just talked about. You're now have this additional payment you didn't have kind of calculated into your budget, and now you're stretched even a little bit further, and just keeps you in this trap of not ever being able to get to a savings account because that money that could have been to the savings account, you're now putting towards this credit card debt or loan debt or whatever the case is. And it's like this hamster wheel that's exhausting, and you could find yourself spending your entire life on if you don't break that habit and learn how to get out of it. So, for me, when I found myself riddled in credit card debt and just like robbing Peter to pay Paul, I got a cash advance on this credit card to make these bills, I was like, enough. I was at one point in my life working 3 jobs for a long time until my credit card, my student loan, and my car was paid off because I just needed to get off that hamster wheel, or I was going to just, to stay on it for the rest of my life. And that's exhausting. So once I was able to start paying off my debt and eliminate those monthly payments, now I'm in a position where I can put that money towards maxing out my 401k, my IRA. So now my retirement's set. And now, what do I want to dream really big about? I was not able to dream at all because I was so riddled with debt. I couldn't even see a way to make it to payday. And I remember Wacky Wednesday at the pizza place near my home in college. On Wednesday evening, I would buy a $3.99 one-topping pizza, and that was dinner Wednesday night, and every meal until Friday morning, breakfast. I had my last piece of pizza, and that was like how I was able to scrape by. And I don't want that for anybody. And it was because I was riddled with credit card debt. So until we can get out of that crazy broke trap cycle, you're just going to keep, rinse and repeat. You're going to go, there's no way out. There is a way out, but it's hard.
So that's great, advice for people who have gotten into themselves into trouble. But, there are some of us that have gotten ourselves out of that, or has been taught by our parents or whatnot, have gotten ourselves financial literate to avoid that type of a situation. And there might become a situation where you might need to pay for something in advance, and you might not have all of the funds to do that at one time or whatnot. So, right. Credit, if you have been responsible all through your time with your credit and using credit as a temporary thing sometimes instead of as revolving credit. Revolving credit is where what we're talking about a lot here, that can become a monster. Like Christy just said about how people think money is evil. So one of my sayings that I get that I say is, money is a great servant. It can serve you well, but it's a terrible master. So you can, if you make money your master, and you can make money your master by having it all and looking at it in your bank account and doing nothing with it and just sitting there, or you can make money your master by spending more than you can afford and let it control you that way. So you can have, unless you're being moderate about everything that you're doing and controlling what you're doing and not having it control you, it can control you in both ways, where you're being too frugal or where you're being too much of a spendthrift. It's controlling you that way. So being moderate and not have it be the center of your life. It's important, don't get me wrong, but credit is part of that story.
It's a tool if used properly. And you can have a situation where you might not, let's just say you might have your money in a CD, for example, and the CD expires in 3 months, but you need to have access to something right now. Maybe you're putting a down payment, or you need some furniture, or even you're going on a vacation and you have your money, you have to wiggle some stuff around. If you have good credit, you can have a 0% credit card that you can put that purchase on and make a plan to pay it off in 3 months. For example, when I bought my home and I did my floors, for example, with the flooring company, they gave me 12 months, 0% interest to pay off my floor. And I took that payment, I divided it into 12. It was part of my budget, and it was paid off with 0 interest. It did not cost me anything extra for my floor. That's awesome. Where I see a lot of people tripping up is they get to a point where they're maxed out on their credit cards, or something happens in their life where maybe they're out of work, ill, or taking care of somebody for a couple of weeks. And let's face it, a lot of people are living paycheck to paycheck. And now all of a sudden you can't make that monthly payment, or an unexpected bill came in and you were late on your credit card. Now your credit score suffers. And then if you have a poor credit score, you're paying so much more in interest over time. I was just speaking with a young lady last week. Because of where her credit score is, she's paying 15.9% on her car. And if I had to take a guess, because she told me it's brand new, I'm going to guess it's probably a $40,000 loan. We didn't look at her credit specifically, but that is telling me she's paying hundreds of dollars more per month than she would if she had a great credit score. So that hundreds of dollars a month could keep you from paying cash for your vacation, paying cash for your next car, being able to max out your dream bucket, to launch your business, to retire at a certain age, to, all of those things. It's just, it can be crippling and keep you from being able to discover or uncover what it's really about for you. It's that important.
Yeah. So to summarize what we're talking about today with Christy, and she's given us some really good, she's busted some myths on credit things that we've been hearing out there. And she's made us known that credit is a part of our society, a part of our overall life. And it, whether we want to or not, we have to understand it. We have to make sure we're educated about it. We have to make sure we're using it wisely, and it's out there. So you have to make sure it's not a choice as to whether I would like to have credit or not. It's part of our society. It's part of us living. If even if you're renting and you never intend to buy your own home, then you still need your credit.
I've seen where people were denied a rental apartment or home because of their credit score.
Or their car insurance.
Yes.
So it doesn't have to do with debt alone. It has to do with, your life, your economy, what we're living in, everything that we're dealing with. So thank you, Christy, for everything. Today, this is our first time that we're chatting on air, and we're going to continue chatting. We're going to continue working together to make sure that we can teach financial literacy and bring financial literacy to every table, whether it's every room, every table, whether it's the boardroom table or it's the living room table or it's the coffee table. It should be a conversation that we make familiar, and it's something that's part of our conversation in everyday lives.
And I want to applaud you for putting this out there. This is amazing information that you're sharing with so many people. It's very, very needed. And I know it's not easy. You put a ton of time and energy and resources into this. So I just want to applaud you, and also to your audience for putting time into their own life to better themselves, to get ahead, because knowledge is power. And education is key.
Thank you so much, Christy. Thank you very much. And we will talk soon.